Our stocks are fading here to finish the week after we hit records on Thursday. But has this eventful start to the year changed anything for the broader 2020 outlook? Jack Manley is the global market strategist at JPMorgan Asset Management. He joins us now. So let's start with the jobs report. Does this change anything about your view of the economy? Is it affirming? Does it signal trouble in some way? What do you make of this kind of number?
Well, I think it's generally speaking a good thing. I mean, anytime we talk about more Americans getting jobs, that's a good thing. The labor market's tight, that's a good thing. But I do think that there is a darker side to all this, and this is something that we've been seeing throughout the course of 2019, even before that, which is that a very tight labor market means inherently there aren't that many more people left out there to come in and work. Now, we're not at maximum employment just yet. I think adding 225,000 jobs is pretty good proof of that, but we're getting there. And what that means is I think we have very serious longer-term supply-side constraints to what economic growth can do really over the long run.
So also in investors' minds right now is the coronavirus, obviously a human tragedy, but
Yes.
We've also been looking at what it means for certain companies. And I think it was kind of amorphous for a while and just, some travel companies and luck and coffee. But now it's really trickling out, especially into retail names. We have Canada Goose, we've got Tapestry. You're not that worked up about it. Why?
Well, I'm not that worked up about it right now. I think, first of all, it is still too soon to make a call. It is early innings when it comes to something like this. But what I think is important to remember is that, first of all, we don't really know what mortality rates look like. They're generally speaking appear to be a lot lower than something like SARS or MERS, which were much larger problems in the past. But I think more importantly, I'd like to think that the Chinese government has learned something about how to control contagion over the last 20 years when it comes to all of these other outbreaks that seem to pop up every 12, 18, 24 months. They seem to be handling things a little bit differently. They seem to be handling things much tougher. And that, I think, has a good outlook when it comes to containing the possible contagion in terms of markets.
What are clients telling you about the election? Are they saying, you know what, we don't agree with President Trump on Twitter, we don't agree with his politics, but the economy is good and the stock market is up. I hope he gets reelected.
Well, I can't speak to that specifically, but I would say that in a good economy and with a good stock market, it is generally hard for an incumbent president to lose that reelection bid. Whenever we're talking to clients, though, the big point that we make is that over the long run, politics really don't matter that much. The economy goes up, the stock market goes up. But even beyond that, our base case as we look out into 2020 is that regardless of who gets elected in November, we will still be in a divided government. And considering how tribal things are today in American politics, divided government prevents meaningful policy change.
You know that stocks goes up thing?
Yeah.
I stole it from their deck like 6 years ago.
Then you trademarked it for your own.
Yeah, exactly. I link back to the same story. Jack, one of the big stories this week in the market has been just what's been happening with Tesla. And, the stock goes up, stock goes down. But when you look at a stock of that size moving with this kind of aggression, does it say anything to you about sentiment right now? Does it seem like that's a sign of animal spirits coming back into this market? And we've kind of seen this wall, you call it a wall of worry. But basically, there's not been a huge burst of enthusiasm for the market, maybe save for the end of 2017. Is this a sign that there is that kind of enthusiasm re-entering the market? Does it make you nervous? Or is it like, oh, that's always been a crazy stock and it's just another crazy week?
Well, I think right now we can see that markets are pretty crazy in general in terms of overreacting or underreacting to certain metrics. But I think at this juncture, we see interest rates very low. They're probably not moving too much from here. And in that case, investors are just desperate for opportunities out there. And so some of those growthier names may be more attractive over the longer run. But I think that overall, this low interest rate environment encourages bullish sentiment. I think from our perspective, it still encourages an overweight to equities despite those headwinds that we might be facing.
And then kind of along those lines, there's a growing notion that maybe the U.S. stock market, and U.S. specifically, we've seen it outperform global peers for a number of years now, but is it part of like the safety trade, right? If there's fears about what's happening globally, are U.S. stocks a place to hide out, even though, of course, there's attendant risks with equities versus fixed income, but are we seeing a bid for U.S. stocks amid global uncertainty in what might be, the textbook's not going to teach you that, but certainly it looks like that to some folks.
Oh, absolutely. It's funny. It has become the the fear trade. I think 2018 is proof of that. I think 2019 is proof of that. We saw U.S. outperformance during times of pretty profound uncertainty. People count on our equity markets. They count on our policy. And when you look at what's going on around the rest of the world, particularly in the developed world, all the headline risk, all the policy risk, all the social and political risk that you see in these regions, I think the U.S. continues to really be the best house in a bad neighborhood when it comes to opportunities out
Do you
there.
think the Fed is causing some undue risk? I look at some of these big cap tech stocks. Great earnings season, don't get me wrong, lots of cash, but some of the valuations on that name, at least to me, seem frothy.
Well, I think when we're looking at valuations, especially for some of those bigger tech names, I think one of the questions that's worth asking is, do we have the adequate tools to properly measure long-term earnings potential? It's something I think about quite a bit. Yeah. We have conversations about what this new economy is when we're looking at all the things that have emerged over the last 10 years. How do you translate that to equity markets? What actually is too expensive for some of these companies that fundamentally could not have existed 10 or 15 years ago? I do think that the Fed keeping rates so low for so long does have the potential to cause a little bit of froth in markets, whether that's asset prices, something like home prices or securities. But I think at least where we stand right now, we compare valuations as rich as they are to where they were during the dot-com bubble, and we're not even close. Mm-hmm.
Did you get people calling you about Tesla this week?
Nobody calls me about any single stock, thankfully.
No one was like, I just want to talk with you about it and see what you're saying.
The last time
so
anybody had big questions about anything was about Bitcoin.
Not even your mom, but they called about Bitcoin, but they didn't call about Tesla.
No.
Very interesting.
All right, Jack Manley, JPMorgan Asset Management, thanks so much for stopping by.
I see you.
Hey investors, Zach Guzman here. Are you interested in learning more about the markets and getting the latest financial news? Well, then click right here to subscribe to our Yahoo Finance YouTube channel. Get the latest up-to-the-minute market analysis, big interviews in the world of finance, and information on how to manage your money every day wherever you are.